Several of our viewers have asked us, is the stock market going to drop? We're going to look at two factors that can alert us to a stock market collapse and recession. So stay tuned for the full segment. Welcome back. This is Richard with Wisdom Investor. Many investors are concerned with the fate of the stock market, with the possibility of interest rates rising. In addition, we have the high cost of inflation. Food is more expensive. Cars are expensive. Housing has increased. Rents have increased. Investors are very concerned what's going to happen to the stock market. So we're going to review two important alerts here to be aware of to determine when the stock market may collapse and a possible recession. The first alert we want to be aware of for a possible stock market decline is the Treasury yield curve. Here's a sampling of a normal yield curve. Down at the bottom left here is the 3-month Treasury bill with the interest rate around 0.5%, and then out to the far right is the 30-year Treasury bill with interest rates around 3%. A normal yield curve has the long-term rates higher than the short-term rates. Now, what can change the yield curve if we start having rising interest rates? Here's a chart of the federal funds rates going back to the mid-1970s. There was heavy inflation back in the late 70s, early 80s. Interest rates increased by the Federal Reserve, and what followed was a recession. These gray bars here are recessionary periods. Every time the rates have been increased, a recession follows, but it doesn't happen right away necessarily. Now, right now, our rates are near zero on the federal funds rates. They start to raise those like they say they will. Eventually, at some point here, a recession will follow. Here's an example of a normal yield curve in this blue line here. Short-term rates are lower than long-term rates. If interest rates start to rise on the short-term level and they become higher than long-term rates, then we get into an inverted yield curve. Now, here's a look at our current Treasury yield curve. Right now, we're starting to see some early signs where long-term rates are slightly lower. Now, we don't see an inverted yield curve yet. The 3-month would have to increase, but that is very possible here with the Fed talking about increasing rates here in 2022. Along these same lines with interest rates, we're looking at the 10-year to 3-month spread. Right now, the 3-month yields are lower than the 10-year. When the 3-year starts to increase and actually goes higher than the 10-year, we get into recessionary periods. Right now, this is where we're at right now. The 3-year is less than the 10-year. But you can see in years past, when this spread starts to decrease and actually goes negative, where the 3-year is higher than the 10-year, recessions follow. The gray lines here are all recessions. Rising interest rates on the short-term level is going to be one of our first alerts to watch. Now, if those rates get up to 2% or 2.5%, they may start to reach a threshold where we start to see a collapse in the markets and even a recession. Keep in mind, rising rates don't always cause the stock market to crash. It has to reach a certain threshold. Our second alert here we want to be aware of for a possible market collapse or a recession is the unemployment rate. This is a chart of the unemployment rate going all the way back to 1950. Every time unemployment increases followed by a recession. The recession is in the gray bars here. Now, currently, our unemployment's down around 4%. There's no sign of a rising unemployment at this time. We're looking at the Nasdaq 100 QQQ on a weekly chart. You can see here the last 6 or 7 weeks, the Nasdaq 100 has been selling off. Selling off or taking profits, a drop in the markets is a natural progression of the markets. They don't just go straight up. Even if we went down 20%, I don't think that would be a problem. Although I don't think it's going to go down 20% at this point, especially since we're not seeing an increase in the interest rates yet and unemployment is still low. So a rising unemployment level and also rising interest rates has led to recessions and stock market sell-offs in the past. So we'll be watching those two very important indicators. I want to thank you for watching and stay tuned for our next episode.